which one gave the gold to JP Morgan HSBC, already hold a huge concentration. Therefore, they control a lot of the gold's reserves, and they suspended convertibility. So you can't even get the gold now. Two different scams happening at about the same time. So here's my thought on that.
Welcome to Gold Silver Pros.
Hey everybody, this is your host, Rob Keynes with 𝑘𝙤𝙊𝙍𝑝ros.com. It's August 24, 2023. And as promised on the live stream on Tuesday, I have a video which has maybe a little bit of a bombshell to it. But really what it is a look at some of the schemes that government seem to be running on their precious metals investors or towards their precious metals investors. We now have a second one that 𝘎𝑗𝑠 has documented on his channel. This is actually a series of videos he put on his channel about 2 months ago. And I'm surprised it hasn't, I know people have watched it, but I'm surprised it hasn't made a bigger impact than it did. It was a really great video series. I'm going to highlight some clips from video 2, specifically a 𝘎𝑗𝑠 series from the U.S. Mint and his conversation with a gentleman there who's worked there for a very long time. And we're going to bring back some of our findings from the Perth Mint series that Daniel and I did 2 years ago, where we found that they were running a fractional reserve metal scheme. And then we're going to add some other stuff to it and ask the question, are these going on at mints around the world? And what is going on with the state of gold and silver inventories around the world? I suspect that there's more to this than meets the eye. And we're going to ask some critical questions, though, at the end of this. Before we do that, though, I wanted to let you guys know, if you're not aware, that we have established our own bullion store. That's right. You can go to www.goldsilverpros.com, and we have a new bullion store up. We just launched this yesterday. It's something we've been working on all summer, and we have a lot of bullion here available to you. We're also working with our suppliers to add bullion to the mix. We've just taken in some additional bars from a local mint here that you will not be able to get anywhere else, at least online. That we'll be adding to the store by the time you see this video this evening. And that'll be in our new arrivals section. Of course, we already have some things in new arrivals, including a COMEX bar slice that was provided to me by Citizens for Sound Money and Jim Forsyth of Silverback Precious Metals. And also we have Silverback rounds there. We have some good deals on government minted coins. I've been told that some of our deals are better than what you can get on the bigger websites. Of course, all we do is try to source metal as cheaply as we can and pass it on to you. If you're interested, go to www.goldsilverpros.com. You can order right off the website, either with a credit card or a bank wire. Either way, if you order off a credit card, all of our prices include the credit card charges. If you order with a bank wire, we will refund those to you at the time that we send the metal out. And we'll be in contact with you during the whole process. We have had orders already. We've already mailed out our first batch of packages less than 24 hours after the orders were received. So we are running very smoothly. And if you guys are interested in getting bullion at a very affordable price, please just jump right into that store. And in addition, the other big announcement is on September 1st, we're going to have a brick and mortar store open as well. That's going to be in Grapevine, Texas, where I live. It's going to be at this address here. It has all the information on the website. Don't come by just yet. We're going to open next Friday, September 1st. We're not open just yet. We're finishing up the showroom and getting ready for you. Nice little map there if you have any questions. Of course, we have a couple of email addresses set up to help you if you have questions as well. All right, now on to the presentation. We're going to start with the U.S. Mint stuff that was on 𝘎𝑗𝑠's channel 2 months ago, and I pulled excerpts. So I've got a string of different videos that I'm going to be providing you, and then I'm going to tie in some of our video clips from the Perth Mint series, all of this curated to kind of get to the point quickly. And then we're going to ask some questions and maybe make some connections. And I think there are some things that are becoming very clear as to how the precious metals market works, but I think we also have questions about what else might be going on. So the first clip here is from 𝘎𝑗𝑠's series. We got a link below in the description for you if you want to go watch that whole thing. By the way, here is the first clip.
See the program implode the way it has and become number 2 or number even 3. I don't know. I don't even know if it's number 2 still in the world as far as popularity. It is a sour taste in all my customers' mouths. Everybody I talk to is like, oh my God, what is happening at the Mint?
And you can imagine someone like me, that came here 35 years ago, came from the financial industry, and brought this program from zero awareness to the #1 traded bullion coin in the world to seeing what's happened to it now. After 35 years, you can imagine I'm,
Yeah.
I can't, it's hard for me to witness what's happened. And I got to tell you, I don't see any remedy in sight. And that's what's sad, because the Mint's procurement office is simply unable to find another supplier, and Sunshine.
All right, so essentially that was with Jack Sermon, who works for the Mint, has been there for 35 years and was claiming some responsibility for helping build that program into the #1 recognized government mint in the world. Bix was on a phone conversation with him, and he was talking about the initial conversation was about no remedy in sight for availability of the metals. Specifically, we'll get into the American Eagles and the numismatics that they produce. I wanted to fast forward a little bit to another clip, which links the U.S. Mint to the Perth Mint, which is why in the second half, we're going to talk about our Perth Mint study, because there is a linkage here between the U.S. Mint and the Perth Mint. They do a little bit of business together. Let's see that video now. This is from, again, Jack Sermon over at the U.S. Mint.
Mint is the only mint on the planet that is legislated to buy silver blanks at any value, at any amount, to meet public demand. And I've been through the law on this. I've looked it up.
And to that point, the Mint does procure some of its gold bullion blanks and all of its platinum bullion blanks. It procures all of that from overseas suppliers.
The gold? They're not legally allowed to do that. Only silver.
No, they can procure gold from overseas suppliers. I know you're going to say, well, the legislation says domestically mined gold from the GATT countries. And you know what? You can write your representative.
Yeah, that goes far.
And you can ask these questions, and they'll probably kind of at some point in time end up on my desk. But we get all of our platinum from a company called MKS or PAMP. You may have heard of.
Yeah, I know PAMP.
PAMP gold bars. They're in Lugano in Switzerland. Yeah. We get all our platinum there, and we get our 24 karat gold blanks from PAMP, and we also do business with the Perth Mint in Australia.
Okay, several things there that are important. He talks about one, or Bix shows that we're supposed to source all of the gold that we use and our gold coins from the U.S. Mint from U.S., ostensibly from U.S. suppliers, and that would indicate U.S. miners as well would be in there, because ultimately they're going to supply it out of the ground. And secondly, that they have a connection with the Perth Mint outside the U.S. Bix says you're not supposed to be able to do that, and he says, well, we do it anyway, and you can write your congressman. But that's what they do. That's been a decision made by the U.S. Mint. I wonder how the U.S. miners or companies that are mining in the U.S. would have comments about that, because there's been a lot, especially in the last 5 years, but probably the last 10, of worry from the miners about the permitting process and being able to operate in the United States and establish new mines. I wonder if some of those restrictions on mining is what's leading the U.S. Mint to look outside, going to a couple of different places, including the Perth Mint. And stay tuned, because I'm going to link the U.S. Mint and Perth Mint together when we get back into Daniel's and I research that we did over the Perth Mint scandal a couple of years ago, which raises and begs a whole lot of questions. We'll get to that in a minute. The next thing I wanted to show you has to do with the fact that the Perth Mint, in their scheme, which I'll get to in the second half of the video, did it with an S&P credit rated agency, whether that be the U.S. Mint or an exchange. I'm going to bring that clip right up front, and then we'll get back into Bix's piece. Here, this piece is from Kitco. This is the CEO, along with the Kitco host, talking about Kitco's liabilities in terms of the metal that it has lent and who it may have lent those to. This is a really good clue as to how some of these things may tie together, which we'll get to at the end of the video.
Basically, what I'm trying to get at, Richard, is the $5.98 billion, which is, according to your statements, it's metals marketed at fair value. Is that all physical metals in the vaults owned by Perth Mint, or could some of that be receivables from maybe your suppliers or for unrefined products?
So that comprises of two additional amounts. One is advances to refining customers, where we have received the metal from the mine site, and we have advanced. The customer has priced that metal, and we've provided an advance to the customer in advance of the refining process being completed. The way the markets work here in Australia, and I think they probably work this way globally, is that all refining settlements are done typically on a T+2 basis. So we receive the metal today, and in 2 days' time, we will provide the customer with payment for that metal. It's in our custody, so we physically have it, but we haven't refined it yet. The final refining, that takes about 10 to 12 working days. And once the refining process is complete, we have that metal in a form that is then a saleable product. So typically that's an advance given to customers prior to the refining process having taken place, but we have physical custody of the metal. The second part of that is where we have stocks with customers, and these are all customers where the stock is either secured by a banker's guarantee.
We'll stop right there, I think.
Hold on, keep going to the S&P. Keep going, Rob. This is important.
Oh, you want to do the S&P in here? Okay, we'll put that.
This is very important. Keep going.
Keep going, guys.
Or a cash deposit, or in a few cases where the customer is deemed to be credit worthy. In other words, they have an S&P credit rating where the stock has been provided to that customer on a consignment basis, but that stock has not yet been priced yet.
Okay, so the point of this video, guys, is to very early in this segment to show you that the Perth Mint lent out metal to an S&P counterparty outside of Australia. And we're going to tie that together with the exchanges and potential of the US Mint a little bit later. I wanted, though, and that was the CEO at the time, he's no longer with Perth Mint, admitting that they lent it out to an S&P counterparty. And I wanted to show you essentially who those counterparties could be. And here we go. And right off of the S&P website, issuer credit ratings, an independent opinion of your organization's overall credit worthiness. S&P credit ratings issuer credit rating provides your credit credential, an independent opinion of your organization's credit worthiness and financial strength. It can be used as an information tool for capital market participants in your organization's counterparties, banks, clients, suppliers, joint venture partners, brokers, government agencies like a mint, and even landlords. So in other words, the only people that are going to get an S&P credit rating are large organizations that, you know, it's not you and me. So in other words, what Daniel and I go on to prove in our Perth Mint analysis wasn't that Perth Mint lent it to the broad market. They lent it to most likely a single large counterparty. Now we're going to get back to the US Mint. I'll get back to why that's important in a moment. Stick with me, guys. But we're going to get back to the US Mint. And there's a clip here where Bix is talking with Mr. Sermon at the US Mint, and Mr. Sermon says he was asked to see what he could get away with in regards to limiting Silver Eagle supplies. This is very interesting. Let's listen to this clip.
Yeah, and more importantly, whatever we get from overseas, you know, we can just use for the Mint's numismatic programs, because those numismatic programs have huge premiums on them, so they can absorb added cost. The bullion program cannot. So even if whatever coin blanks we could get overseas were used for the numismatic silver programs, then all that silver that we're getting from Sunshine that goes to the silver numismatic programs, that would all now be freed up for the bullion program.
But the bullion program, it can absorb any price by law. Because, right now it could absorb what, $15, at least $10 of the $15 premium, if it.
Yes.
But it's not a money making.
Yes, that's true.
The bulk program is not supposed to be money making.
All that's required, legislatively, is that the program not operate at any net cost to the taxpayer.
Right.
So you're right. If it costs me $5 an ounce premium to get blanks, then I'll charge $5 plus something.
Right.
But it won't make me competitive in the marketplace when I've got other sovereign mints selling basically the same commodity product. It's all an ounce of silver, 3/9 fine silver. It will make the Silver Eagle much less competitive.
But I don't think that's a problem, and I'll tell you why. Because right now, the only reason people aren't, and they still are buying Silver Eagles at $15 over, but the only reason they're not buying is that the quantity is not being supplied in the same quantities as other sovereign mints. And of course, you're not going to have great numbers this year because you didn't even give us an opportunity to buy them. Really,
we didn't make them. An internal management decision was made not to make them.
Right, and so
and believe me, they came to me because
I would just like to stop there. What he said, an internal management decision was made not to make them. That's illegal, 100%. So he's admitting that it is the management of the U.S. Mint that decided not to make Silver Eagles to meet demand, knowing exactly what they were doing. Listen to what else he says.
I was a primary dealer. I ran a primary dealer trading desk before I came to the Mint, so I know how this works.
Right.
And so they came to me and said, basically, what can we get away with that's palatable?
Yeah, that is a shocking revelation. What can we get away with that's palatable? I mean, that tells you, that sums up the Mint right there. What can we get away with? Legally, you can't get away with anything.
Good comments by Bix there, in that there was a management decision made, despite the lawful requirement for the U.S. to supply as many American Silver Eagles as the public demands, that they made a decision to move over to different types of products and not to supply everything that they need to the public. In the next section, we'll talk a little bit more about exactly what they are doing as we get into clip 5.
Anyway, here I go.
Why did they want to?
If demand's north of 30 million, and you only decide, they want to know, well, what number can we make? Well, we're not going to get phone calls and letters from Congress, congressional.
Right. But why would they want that? I mean, wouldn't they want the program to do well?
Look, if you're running a business and you have a lot of different product lines, every product line has a different margin, my friend. Every product has a different margin. And if you only have a finite supply of something, as a business, you're going to maximize the sale of products that makes your business the most margin.
But that's illegal. What you just described, from what the law says, it's only, I get the things you can mark up, and you guys do, obviously, from the website. But from the law, it says you are required to make the silver bullion, bulk bullion program available to the people at your cost. There's no markup that is written into the law for the bulk bullion. And I'm not asking if you guys mark it up more or not, but there is a requirement to supply it. There's not a requirement to supply the commemorative coins and all the other coins, just the Silver Eagle bulk.
Yeah, no, you're right. You're right. The legislation, my understanding, has been that the bullion program, by and large, is primarily supposed to just be a break-even program.
Yeah, that's the law.
Whatever my costs are,
you pass through.
You put a little bit of a buffer on it, and that's what you pass it through to the consumer.
Yep.
So that's interesting. A lot of things came out there. He's basically saying that, yeah, they are charging a premium. They're not really required to, or specifically allowed by law to charge a premium, but they're doing it anyway. And further, that they're not providing enough American Eagles, and a lot of that silver may be going towards, or even gold, maybe going to numismatic coin programs, which are not as efficient for users. I mean, there is a numismatic market, and yes, you can make money in numismatics. I've done it before, but that's not the point. The law requires them to provide American Silver Eagles, not focusing on higher premium products for the mint. The mint is not supposed to be a source of revenue, in other words, according to the law. We'll wait until we get to the next clip, because now he's talking about another dirty little secret of the market and how they've been treating premiums with regards to how much customers are paying. And I thought this was also a very astounding admission by him. Again, another clip of Bix and Jack Sermon of the U.S. Mint.
Here's the other kind of dirty little secret, if you think about it. When the program came out in 1986, and it was marketed and targeted and positioned as a break-even program, and that the mint shall sell these coins to the public at its cost, plus some buffer to ensure all program costs were covered. Well, when the program launched, gold was around $400 an ounce. Mm-hmm. And if you just use gold as an example, what's 3%, which is my premium on 1 ounce gold? What's 3% of 400 versus 3% of 2,000?
Right.
So as the price of gold has soared, the mint has not lowered its premium. And so the mint has gone from making X margin to making quite a bit more margin.
Right. Yep. And that's reported in the annual report.
Okay, so what they're saying there is they're making more money because they haven't changed their premium rates, even as the price of precious metals has risen. Again, it's more of a profit-making enterprise, even though the law doesn't require it to be. As Jack said and admitted to, and Bix showed up on the screen, it's required basically to be a break-even or near break-even enterprise. And yet the government seems intent on making money off of that, partially through limiting sales of the flagship product, American Eagle, which according to law they're not supposed to, and then putting some of that in numismatics. And then even when the overall values go up, not reducing the premiums, because if premiums are a percentage of the coin and it costs the same to mint the coin, whether it's $20 or $25, you should lower your premiums because your cost as a percentage of minting went down of the sale price. So as costs rise above, the cost that you need to take a premium out, you should lower your premium percentage so that you're staying in line with cost. But they didn't do that. So even on the things that they're supposed to be breaking even on, they're making money on, as well as, pushing people over to more numismatic coins, which are designed basically for them to make money. Now, there's another one here. The last clip I'm going to show from Bix's video series talks about the mint made a conscious decision to limit American Eagles and overall minting because of COVID. And Bix is going to go and point out that, well, you actually doubled production. So it seems as though the guy working at the mint either is not aware of or is not being completely honest with regards to how COVID affected the market. And right after that, we're going to go back to a clip by the CFTC commissioner talking about market pricing as well. And we're going to tie all this together at the end. So stick with me, guys. There's a lot here, but at the end of this, there's going to be a payoff, and it's going to be looking at the various schemes and how they work and getting a broad idea of how the precious metals markets have been managed by government agencies and government regulators, and how you guys may want to be aware of that, because we'll have some other questions in. I'll wait to the end for that. But here is the discussion of COVID and minting, which the gentlemen seem to have a disagreement on.
Bore you with this stuff, but when COVID hit, the availability of physical silver and gold, for that matter, began to dry up. A lot of the physical silver was over in Europe and London.
But that's when you guys doubled production.
They couldn't get the physical silver to North America.
But
I would like to point out, completely different from what they made in 2020 and 2021 when COVID was just kicking in. The U.S. Mint doubled their production. So what he's saying here is not true. And I've heard it from other mint employees. I've heard it from Tom Power over at the Sunshine Mint. What they're saying is not true. In 2020, the U.S. produced 30 million silver eagles. In 2021, the U.S. produced 28 point something million silver eagles. So what they're saying and what has been regurgitated many times is not true.
Did you double production?
And because of that, the Mint had to raise its premiums on silver and gold. But since then, it lowered its premium on gold back down. But interestingly, and nobody has called us on this yet, we didn't lower our silver premium back down. So we used to be at, I don't know what, $2.50 or something.
Yeah.
I can't remember. I can't keep track of all the changes, but we raised it to $2.95 where it is right now. When COVID got over and the supply of physical became available, the hedge, since you brought it up, the premium I have to pay on the hedge on gold, which, maybe during normal times is 25, 50 cents an ounce over the fix, was $5, $6, $7, $8, $9, $10.
Yeah. But see, that's the thing about COVID, because Tim Power said the same thing, the guy at Sunshine. He said the same thing about COVID, and yet in 2019, you guys did 14.8 million eagles. In 2020, it was 30. And 2021, just the heart of COVID is 28. So, I mean, I hear and I understand the answers why it didn't work, but the numbers are proving something different.
And that's a good point from Bix. The numbers are proving something different. And there's some other stuff that I want to point out. In that segment, he talked about the demand for eagles during COVID fell, which is not true. The price rose substantially, which indicates that you would have higher demand, at least in a normal market. So I want to show you guys a price chart of what it actually looked like back then. This is just for macro trends. This is a long-term chart of silver. You can see here a 100-year historical chart. Of course, you see the previous high, 2011, gold and silver. Gold hit an all-time high and silver touched on its previous all-time high, and then silver fell back down. Well, and this is a crisis, right? Silver goes up during crisis. What do we talk about on our channel all the time? Precious metals do well in a crisis. More demand, higher prices. Certainly during COVID, which was 2020, I believe in January 19, 2020 is when we had either the first documented case or when the government officially declared COVID it came to the U.S. I looked that up, by the way, for the video. Very beginning of 2020. You can see this rise from the very beginning of 2020 that stayed up all the way through the summer before it came back down. So the price had risen quite a bit. And not only that, but there wasn't a lack of availability to produce American Eagles or numismatics or any silver coin, because as you look at the stockpiles from about mid-2016 to where it peaked right at the beginning of 2021, this would be, we all know as silver squeeze. The availability, at least in the U.S. and the COMEX, the Commodities Exchange, our official industrial market, actually went up quite a bit. It went up from about 150 million ounces to 400 million. So you saw about 250 more million ounces in 4 years get onto the exchange. So if we saw more stockpiles of silver, presumably the Mint will be able to source, or Sunshine or whoever's providing the blanks will be able to source that silver off the market. It's readily available. And the prices didn't even rise until 2020. So when the stockpiles are rising, the price is actually falling a bit. It would have been cheaper, or stayed even or fell. It would have been cheaper for Sunshine or whoever else to source the silver. You just simply go on the market and buy it. So the arguments that this gentleman was making, Jack Sermon at the Mint, around availability during COVID and prices, or availability even after, don't make sense, because we had a huge amount of silver available and the prices were relatively cheap until COVID hit. So it doesn't seem to preclude, Sunshine Mint or the U.S. Mint or any mint from participating in that market and sourcing silver. One other thing that happened that was very interesting during that time, if you remember at the beginning of 2021, I believe it was the last couple of days of January, the first day of February 2021, we had what we call silver squeeze, where silver price rose substantially. A lot of people were buying the SLV, the ETF, and it was raising the price of silver overall, because that is a signal that retail demand is increasing. When people go buy the ETF, it's a retail product. So, you know, mom and pops and kids and everybody were buying the SLV. They tamped down the CFTC regulator, in conjunction with the markets, tamped down the price. And I know that because this came out in a public conference at 𝘎𝑘𝑎v, where Rostin Benham, who was the acting CFTC chairman then, and now the actual commissioner of the CFTC, which is a regulatory agency of the commodities markets here in the U.S., said it. So I'm going to play that clip for you real quick. They were actually limiting the price so that it didn't rise too high. Let's look at that.
The CFTC put out a public statement around the silver markets, and you're keeping a close eye on that. Can you follow up on what the CFTC may be doing in regards to this rise of retail participation, making sure that, you know, these important vehicles that we talk about, futures and options, are accessible to the retail participants, but also with the proper risk disclosures and the proper oversight of those products? So give us some thoughts on how this phenomena is impacting the CFTC.
Yeah, thanks, Walt. It's a great question. It's something that I've been thinking about, and you know, the events around the silver markets happened, you know, shortly after I took over. I think in late January, and I think it's important to distinguish what an equity space with what happened in our markets, in the future space, specifically with the silver contract. And in many respects, the resiliency and the market structure of the futures market really were able to tamp down what could have been a much worse situation in the silver markets. And just pointing to a couple things that I've observed over the past couple weeks, and I shared with my colleagues within the U.S. government, and that are either unique to many respects to the equity space entirely. We have sort of history and precedent in the futures space. You know, we have a match order book, don't have rules. We have T+1 settlement. The clearing infrastructure as a general matter historically within the futures space is built in and very strong. Initial margin, daily mark-to-market, position limits. All of these things together, I think, really were very effective in managing what was at some point in those few days in late January potentially a challenging situation, and give credit to the exchange for utilizing its authority and some of the tools it has within the margin space to control the sort of the price and the volatility of the silver contracts. But I think all those things together are important elements of markets that both sort of transparency, resiliency, credibility, as we talked about in the sustainability space, that make our markets very, very resilient and strong. And we are keeping an eye on it. I've worked with the division directors across to make sure that we're, uniquely looking at the clearing space, the intermediary space, and the exchange space to make sure that the rules and regs we have on the books are going to be able to approach and manage this new technology and sort of new front in our market space. That all said, and you mentioned this, the larger policy question for me is about retail access and retail market participants. If you think about where we are today, vis-a-vis 12 months ago or 13 months ago when the pandemic really kicked in, we have individuals at home utilizing technology with cash and in trading in markets. We're seeing in the equity space, and we're certainly seeing a kick up in the futures market as well.
So essentially what the commissioner said back then was they tamped down the price when it got, in fact, I'll show you on the chart when they tamped down the price, because we covered this back at the time. No, a lot of the market did. They tamped down the price right here after it rose. Actually, after it started rising 2021, it started to rise again at the beginning of 2021. They tamped it down at 30 and brought it back down. And the reason they probably did that was because there was a run on silver, and at that same time, there was a run off. You started to see people pulling silver off the exchange. And not only did it happen here in the US, it happened over in London as well. They pulled metal off of the London exchange, and the LBMA came out some months later and said, boy, if that had gone on for 3 more days, we wouldn't have had any liquid silver. but there was plenty of silver there. And my question is, why couldn't Sunshine Mint source that and give it, to the U.S. Mint for use in the Eagles? It seems to counteract what the gentleman said that Bix interviewed at the U.S. Mint. Okay, so that's going to end the U.S. Mint part of it. Now we're going to get into the Perth Mint and go over some pieces there, and then I'm going to wrap it all up together for you at the end of the video. Stay tuned. I think you guys are going to love it. Let's start now on the first part of the Perth Mint, and then we'll link them together and ask our questions about what's really going on at the worldwide mints and the worldwide exchanges with regards to the precious metals, gold and silver. And essentially, the analysis that Daniel and I did 2 years ago, Daniel's a CFA, and he originally started looking at the Perth Mint's financials. And we found that they were running basically a fractional reserve metal system. They were loaning out their customer metals and backing them with receivables from the mines, hadn't gotten there yet, and putting their customers at risk for multiple years. All the while, they earned interest on it that benefited the government to the detriment of the safety of their customers. We're going to walk through some clips explaining that. And then I'm going to put the pieces together as what I think may be happening. That'll be the payoff that you guys want to pay attention to. So we'll do the first video clip. This first video clip is from the original series of 4 or 5 videos that Daniel and I did 2 years ago that just introduces what's going on. Then we'll get into the details. Hey everybody, this is Rob Keynes with 𝑘𝙊𝙇𝙄𝙊𝙍𝙀. It is Thursday, September 30th, 2021. And back with me is my good friend, Daniel Vigario. Many of you know him from our Perth Mint series, where Daniel, as a CFA, had analyzed the 2020 financial statements for the Perth Mint and found, through his analysis, rebuilding the trial balance and doing some extrapolations of the data in the report, that he believed that they were running a fractional reserve gold system and doing quite a few other things. He's going to explain, for those of you who are new to the program and haven't seen that Perth Mint series, what we found in last year's financials. And what we'll spend the bulk of the time talking about today is the 2021 financials, because those have come out recently and Daniel has analyzed those and has some new insights for us on the Perth Mint. Daniel, how are you doing today?
Hi, Rob. Good to see you again. It's great to be with you once again, and the viewers. Thank you.
Yeah, thank you. And first of all, Daniel, thank you for taking the time to join us. And secondly, all of the hours that you put into this. I know rebuilding trial balance sheets is hard work. It takes a long time. It takes a high level of expertise. So, I think the audience definitely appreciates all the time you put into this, because if we hadn't had you looking at this probably would have gone unnoticed, and all of the conclusions that we have from it, the public wouldn't know about. And I know that you had expressed a little bit of frustration that it appears as though Perth Mint kind of got away with what they did. But I think the value here is in letting the public know what they did, because eventually, all the things going on in the metal markets coming to light, people are starting to wake up to that fact, and there is going to be a pushback coming. And this will contribute to that. This will contribute to the education. So I just want to say thank you for that. And I think it's tremendously valuable to the gold and silver community. Yes, we can.
Okay, so at a very high level, we took the 2020 financial statements for the Perth.
And what's happening here is we're going to get a summary analysis of what he saw, and then we'll get into a little bit of details, and then we'll wrap up the analysis right after.
This is the 2021 accounts we're looking at here. So we took these financials, and we, as you said, I created a trial balance, which is just simply taking the balance sheets, the P&L, stacking it on top of each other, so that you can see all the data in one nice, neat column, and then you can analyze it month on month, year on year, which we did over time. So for the viewers that are new to the channel, don't get too frightened when you look at the spreadsheet. But essentially what we're looking at here again is just the balance sheet descriptions, or the balance sheet classifications are sitting over here. And then we've got current assets, which is part of the balance sheet. We then have liabilities down here, also still with the balance sheet. We have equity, and then beneath here we have the profit and loss, which is the income statement. And then all of that needs to tie to zero, which is down here. So all in accounting terms, debits and credits, all the all the items on the financial statements need to power down to 0, and then you know that it's correct in terms of what you constructed in the trial balance.
Okay, so to stop you before you go further, for those of you who don't have an accounting background, essentially what he's doing is he's taking the published financial statements where they write it in long form, paragraph form with data tables, and he's rebuilding what should be their trial balance sheet from that. So he's basically reverse engineering it from the data that's in that published and audited financial report for Perth Mint, as well as the notes. And the notes are very key because the notes we saw last time, the notes weren't fully explanatory of what's going on. And you're going to show us where some of these notes have changed and provide us even more updated information from what you had last year. Okay, so I'll let you go and tell people, you know, basically what you found from the 2020, and then we'll get into the 2020. Okay, so that's a summary analysis. In the next clip, he's going to go into this in just a little bit more detail. This will be the detailed summary of exactly what is going on.
And then just on the final point on that, we also discussed how that receivable attracted revenue interest. So in summary, we're trying to answer 3 questions in the last couple of series. So question number 1 is the Perth Mint running a net short unallocated precious metals program? So what that means is if I look here at this row, the valuation, this is 2020, this column over here is 2020. So the value of the customer accounts plus the value of the leased metal, so 1.7 plus 4.6, total 6.3. Is that greater than or less than or equal to the value of the precious metal stock in inventory being unallocated precious metals in the vaults? So, which is this number over here, being 5.4. So to answer that question, if I just scroll down to the summary, we had 1.7 plus 4.6 is 6.3. In the actual vault for unallocated metal, the Perth Mint had 5.4. So the net short to the tune of almost $1 billion Aussie dollars. That was question 1 answered. They are definitely running a fractional reserve system. As of June 2020, they were short $1 billion Aussie dollars metal in the vault versus obligations to customers and leased.
So as of last year, they had more borrowings than they had metals, to the tune of about, looks like about 17%, because they were leveraged 1.17.
Yeah.
So they had 17% net short, which amounted to 929 million Australian, right?
Correct. Yeah, that's correct. That's question 1. Question 2 was, so that speaks to the fact that the Perth Mint customers, unallocated customers, are exposed to a situation where if everyone wanted their metal delivered to them, so converted from unallocated to allocated and delivered, there would be a short of $1 billion Aussie dollars. That's if the customers plus the lessors, so the bullion banks that had lent the Perth Mint metal, if they all wanted their metal back at the same time, there would have been $1 billion Aussie dollars short. And that speaks to the fact that customers are now exposed to a delivery risk of precious metals, physical precious metals.
So Daniel, to ask another question to clarify one of the points you made in our previous videos, this wasn't always the case with Perth Mint. A few years ago, they hadn't borrowed more than they had, or they weren't net short, and they've only done that within the last couple of years. Is that correct?
So in 2017 over here, you can see the position was positive all the way through from 2017 back to 2013, and after 2017, so 18, 19, and 20, they were growing the significant net short position. So unallocated metal in a vault versus the obligations to customers and metal lessors being put in the banks.
Daniel, may I ask you to increase the size of that just a wee bit so that we can get those numbers nice and big for people to see? Okay, thank you.
So the next question that's risk 1 that the customers are facing that they're unaware of. So Perth Mint customers, unallocated customers, are not aware of this risk. We've made that quite clear as of June 2020 that the risk is there and they should be aware of it. The second question is the Perth Mint liquid? In other words, so customers have their currency with the Perth Mint, they've invested it in precious metals. We understand the risk of the short position, but is there a risk that the Perth Mint could go bust? Now, we know the Perth Mint is backed by the Western Australian government, so in theory, they can never go bust because they're backed by the government. However, it's important to know whether the entity that you're dealing with, that you're trusting with your metal, is actually liquid. So what does liquidity mean? It means, is the current assets greater than the current liabilities on any company? And if that number is positive, that means they are liquid. If the number is negative, it means they are illiquid, or they're running it in a liquid position on their balance sheet, meaning that they could go bust if cash becomes constrained.
Okay, and you're talking about now not just the metals, but all of their financial accounting, right?
Correct.
Okay.
All the entire balance sheet, current liabilities, current assets. So if we stay with these numbers over here, we had 929, almost a billion Aussie dollars net short. Then we look at their cash on balance sheet of 127 million, their current assets of 901 million, so almost a billion, and then the current liabilities of 254 million. So the total value of all of their current assets and current liabilities, excluding the short position, is 783 million positive, and the addition of 783 plus the negative 929 million gives you an illiquid position of 146 million. And that illiquid position was sitting there in 2020. There it is there, as well as in 2019. There it is there. And prior to that, they never ever had an illiquid position. They were always positive. Assets, current assets exceeded current liabilities.
So for their fiscal year 2019 and 2020, they went illiquid, meaning they had more overall liabilities than they had assets.
Current liabilities and their current assets, correct.
Okay.
And then the final question was whether the Perthment was in some way involved in the manipulation or suppression of precious metals pricing. And that came through by looking at their receivable on their balance sheet at fair value. The reason why they've got this short position is because the Perthment, we'll look at it a bit later, actually sold precious metals to a S&P credit rated counterparty. Richard Hayes mentioned it in one of his videos in his interview. And because they sold that metal, being customer metal, it created the short position, and that materialized on their balance sheet in this value over here, which I'm not adding together because I was able to split it out, but we'll get to that a bit later, of 842 million. So they had a large receivable on their balance sheet of 842 million Aussie dollars, and that created the net short position in precious metals versus customer accounts because they actually sold it. Now, we discussed on the prior shows that this is a genuine receivable payable in the future. It's a metal that's gone, it's left the Perthment, it's sitting with an S&P credit rated counterparty, and that suggests that they are involved in some way in the suppression, or at least involved in manipulating in a way the precious metals market somehow, because their counterparty is a very big counterparty. But we will touch on this a bit later because I've got some evidence on that. And
to bring everybody up to date, if you're new to the series or you've forgotten since we last did one of these, I believe it was the CEO of the company which came out in an interview on Kitco and said that that receivable belonged to an S&P rated entity. An S&P rated entity means you're a big entity. It's not a family office. We're talking about like a major global corporate, a metals exchange, somebody along those lines. Or as well, it could have been one of the mints. And so basically what Daniel's outlined for us here in this summary is the fact that Perth Mint had two things going on. They essentially lent out and received interest income from their customer metals, unallocated customer account metals, to an S&P rated counterparty outside the US who used it for something. Was it an exchange? Was it the US Mint, another mint? Was it the COMEX, a big company? We don't know. But they earned interest income for that. In addition, they kind of covered themselves by counting some receivables they were going to get from the miners, which weren't there yet. They weren't in inventory. It was doré bars that weren't even fully refined that you could give to a customer. They had to be refined, that were a receivable that the miners hadn't given them yet. And that's how they covered themselves in the scheme. Now, if the customers had gone to redeem their metal through the Perth Mint's program, they would not have been able to do it. That's the interesting part about it. Now, the next section that we have gets really interesting as well, because we're going to be talking about how basically Perth Mint became a bank. This is a quick section, about a minute and a half. And then at the end, stay tuned. The last clip I have also talks about how they wound this down, how they covered themselves, but more importantly, how Goldman Sachs got involved on the ETF. You're really going to want to see that. Stay tuned for the next two clips. This is about a minute and a half talking about how, in my wording, Perth Mint became a gold bank instead of holding their gold for the benefit of their customers.
an interest income to the Perth Mint that were actually.
Let's start beginning.
And then just on the final point on that, we also discussed how that receivable attracted revenue interest, so an interest income to the Perth Mint. They were actually charging interest on that receivable, which supported the fact that that is by definition running a fractional reserve system. You've got metals in the vault, which is lower than your liabilities to your customers and the lessors, which materialized because they sold it to an S&P accredited counterparty. They earned interest on that receivable, which you proved throughout for 3 or 4 years. And that is how banks work. Banks take customer accounts and they use it and they earn interest on it, and the customers are not aware of this. So that's what
they weren't just a depository. They weren't just a place people could store the precious metals. They became a gold bank.
In a small way, correct.
Yeah. Okay.
Obviously in a very small way, but that's what happened. And the customer, we're just trying to prove that the customers are not aware of this, and we try to bring it to light.
Yeah, so the customers weren't aware of this, which is an issue, because if you're signing up for a service and you don't know that especially gold and silver, because why do we hold gold and silver? It's to protect ourselves in times of crisis. If that entity like the Perth Mint is lending it out in a fractional reserve system like a bank and it's not there for you, that puts the customers at tremendous risk. Here we get into the part talking about the ETF. Stay tuned for this one.
Accredited counterparty repaid that receivable, and that cash then was used to pay down the liabilities to the bullion banks, which then reduced this net short position. And I anticipated that's exactly what they would do, and they did that. But technically, they are still net short. Now, the Perth Mint will argue they are not net short because they have another asset on the balance sheet, which we'll discuss a bit later. But technically speaking, metal in the vault, not anywhere else, not on a mine site, not under the ground, in the vault, they're still short 328 million Aussie dollars. So if everyone ran on the Perth Mint, all customers wanted all their metal back, as well as the bullion banks, they would be short 328 in their vaults.
Okay, so you broke up for just a second, so I'm going to restate what you said. You basically said just taking metal in the vaults, they're net short. It's not taking into account any metal that may be coming from the mine, so on and so forth.
Correct.
A receivable, something coming to them. What's in the vault versus what they should have, it's less in the vault than what they should have.
Correct.
Okay.
And it reduced because, as I said, they redeemed the S&P accredited counterparty, paid back almost 550 million Aussie dollars from that receivable from last year that we discussed earlier.
Okay, great.
All right, next question. Is the Perth Mint illiquid? So again, 328 is the short position. You take the cash on balance sheets of 191 million, current assets of 400 million, current liabilities of 239 million. You get a 325 million aggregates of cash and current assets, current liabilities, and 325 plus the negative 328 million actually gets you to a positive 24 million. So now
it's a 352 positive. You said 325. 352 positive.
52.
328 negative gives you a net positive of 24,820
million. 24 million, yeah.
So now they're not illiquid. They actually have more current assets than current liabilities. And pay attention to how they do this. I'll pause the video for a second. Pay attention to the next section. This is really, really interesting.
That happened because they liquidated the ETF. So you can see the move from a negative 146 million to a positive 24 million is almost the same value as the net position of the ETF. Remember from last year, the ETF, the Perth Mint seeded 106 million Aussie dollars worth of metal into the ETF, if you remember.
Yes.
They got external investment of 345. So 345 less than 514, which is the total value of the metal in the Perth Mint, in the ETF, gives you a seeding value of 169 million. They sold the ETF in 2021, and by selling it and putting that metal back into stock, it caused this positive liquidity position. So now they're all square.
So they sold the ETF to Goldman Sachs, I believe. And I think, if I recall correctly, the announcement on major financial media was that Goldman Sachs then suspended, in some ways, redemption of the metal through the ETF, so that those who now currently have a position in the ETF may not be able to get their metal that was sold off to Goldman Sachs that Perth Mint no longer owns. But you're saying the sale of that helped to bring the Perth Mint to a liquid position in terms of current assets over current liabilities.
Correct.
So essentially what happened there was the Perth Mint had gotten themselves in trouble, I think, because they had lent out a bunch of metal. It all wasn't coming back. The mine supply wasn't covering them. The S&P counterparty to the tune of about 550 million. Supposedly they did get it back, at least on the books, but they had some left over. And what they had to do to get positive by just 24 million on the books and not be insolvent, the risk of going out of business. Not only did they not have the metal, but they could have gone out of business. They sold off this ETF to Goldman Sachs, and supposedly Goldman Sachs received all of this gold, and Perth Mint got all the money, and that, you know, bringing money in, sold an asset, get cash. Now all of a sudden you're liquid. The problem with that is there was an announcement right after in the financial press that after Goldman Sachs acquired the ETF, this is here on ETF Strategy Hub. This is where they track what goes on a lot of ETFs, not just gold and silver. Listen to the new custodian here and how Goldman Sachs suspended convertibility into the actual gold. It says, but while the fee, listing, venue, and investment objective are all unchanged, the original custodian, the Perth Mint, has been removed. And along with it, the ETF's unique guarantee from the government of the state of Western Australia. Also out with the Perth Mint is the ETF's novel convertibility feature that allowed shareholders of the ETF to exchange their shares for delivery of physical gold in the form of bullion bars and coins issued by the Mint. In its place, the custodian is the London branch of JP Morgan Chase, one half of a duopoly of banks, the other half being HSBC, that is home to an increasingly large and arguably alarming concentration of approximately 2,500 tons of ETF-owned gold. Even the ETF strategy website here is questioning who actually got this. Goldman Sachs bought it. It's administered by JP Morgan. Goldman Sachs immediately said, you can't have your gold for your shares. And so we don't even know if the gold exists. And it no longer, the Perth Mint, one of the benefits was it was backed by the government. So if anything happened to the gold, the government would have made good and paid off. That's gone. So you don't get a potential payoff in case something happens. And we don't even know if the gold's there because they said, we're not even going to redeem. So the poor Perth Mint shareholders went from having a guarantee and actually thinking they had the gold, a guarantee of the government and the gold, to not having the gold and not having the guarantee. So if you're in Goldman Sachs' new ETF, which has been rebranded under Goldman Sachs, do you feel safe? Given the Perth Mint scheme, I don't know that I would feel safe. All right, let's sum this up real quickly for you and ask some key questions. We talked about a scheme that the U.S. Mint had to artificially limit the amount of silver eagles available, even though we showed that the CFTC was tamping down price and allowing them to buy it cheaply. Rostin Benham said that. He was, the commissioner, and also that there was robust supply on COMEX. So presumably Sunshine Mint or whoever could have gotten it. If Sunshine Mint didn't have the capacity to mint them, the U.S. Mint could have gone to somebody else to supply their planks. But the U.S. Mint artificially, through a management decision, decided to limit that and then push people to numismatics to make money. That was a money-making scheme. The Perth Mint did it differently. They, under the table, without telling their customers, sold off some of their gold and silver, put this huge liability on the balance sheet, made interest income from it. And then when they still couldn't remain solvent getting some of that back, or presumably they didn't get it all back, they had to sell the ETF shares, which is part of their gold scheme in Perth Mint, to a bank, which one gave the gold to JP Morgan and HSBC, already hold a huge concentration. Therefore, they control a lot of the gold's reserves. And they suspended convertibility, so you can't even get the gold now. Two different scams happening at about the same time. So here's my thought on that. We know that Western Australia government took advantage of their customers. We know that the Perth Mint resolved a large portion of their net position by selling the ETF off. We know the U.S. Mint used artificial shortages caused by a conscious management decision to allocate silver away from American Eagles to more profitable investments. We know from public testimony from the CFTC commissioner that the U.S. regulator, the CFTC, acted in concert with the U.S. exchange to price limit silver during a period in which investor sentiment in the metal was very strong and prices were surging quickly. We know that COMEX supplies rose during this entire time frame, suggesting plenty of physical metals available. With low prices and abundant market supply, why did the U.S. Mint have issues sourcing blanks for the Eagle program? Well, they didn't, because they printed twice as many. That was not the truth that we heard. So they have the story that, it's limited, when we can see in their own disclosures that they doubled the amount that they sold. But at the same time, they were pushing the excess demand over into numismatics investments and increasing their revenues when by law, that's not what they're supposed to be doing. Price controlled environments would seemingly make it much easier for the Perth Mint type of scheme to succeed because it limits the upside price risk the Mint may have in collecting the receivable back and their counterparty not having to pay a lot more. So that price control scheme would seem to have benefited the Perth Mint and their counterparty to be able to do this scheme without a lot of financial risk, which probably allowed them to do it because the way silver price is rising, it might have bankrupted Perth Mint. They might not have gotten all of their gold and silver back. Additionally, overselling metals that don't actually exist on ETF-like markets would seemingly work to create shortages of silver while providing cover for schemes such as the U.S. Mint used to limit U.S. Eagle sales and profiteering on more expensive gold and silver coins. So the following questions that I have, hopefully you guys out there will help me research and send me stories. The rest of the gold and silver community will help answer these. These are the questions I have after looking at these two schemes. Where did the rest of the Perth Mint metal go? Was it used to fund the U.S. Mint, the COMEX market, or some other S&P rated entity? It went to one of the big guys who was getting that Perth Mint metal. How many other government mints are also running profiteering schemes at the detriment of the customers that we don't know about? Certainly BIX has been covering the U.S. Mint. Other people have been covering the U.S. Mint. And then Daniel, brought that research and data from the Perth Mint, and we covered it on the show 2 years ago. If we didn't have these watchdogs out there, how would we know this is going on? How many other mints are involved in this? Is the COMEX in league with this? Are the various regulatory agencies looking the other way while this is going on? We don't know. And lastly, did the American Commodities Exchange regulator, the CFTC, knowingly tamp the price of silver and also possibly gold, even though it wasn't admitted, to allow for such schemes to occur while in a price-controlled environment? Those are key questions. We do know that there are two big schemes that now have been exposed. How many other schemes are going on? And last question I'll have for you, the retail buyer, how much do you trust that essentially what you're told in an ETF investment or what you're told about the exchange or the availability of metal on a mint is even true? Are there half-truths or lies baked into this entire cake? And how much metal is actually available versus how much is being pledged a bunch of different places in these schemes where we may actually have more shortages than we think, but those shortages are used to profiteer in products that normally, people wouldn't invest in otherwise if they felt like the cheaper products were available, such as American Silver Eagles, priced appropriately and not at $12, an ounce over spot price like they have been, for a long time. Those are questions I think the market needs to ask. Now, by the way, I'm not providing financial advice. This is research. Do your own research, contact your financial advisor before you invest in gold and silver. But remember, we do have a store. So if you decide through research and talking with your investment advisor, you do want to invest in gold and silver, we ask that you just take a quick look at our store. We're building out our product catalog. We think we have very competitive prices and it does help the program. We do appreciate that support. And that store helps me to spend the time doing this type of research and bring it to you so you're aware of what's going on in the markets. And also remember, stay tuned on Friday. We have a weekly market wrap and we'll do a deep dive on what happened to gold and silver this week, what's happened in the macro economy, and we'll give you the stories of the week. Until next time, this is Rob Kientz with Gold Silver Pros.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.